So, welcome back and let us continue our discussion about quantitative finance and the area of options which we are studying. So, then the last class we ended at the stage where we wanted to discuss what is the basis risk. So, basis risk in very general sense is the difference in the spot and the futures, considering that the spot and the futures are based on a particular asset, and also the fact that the spot price which is there exactly mimics the demand and supply of the actual product which you are buying and selling, and the futures which you are trying to buy or sell, futures forward whichever it is. Consider I am basically trying to interchange the words, even though the concept wise they may be same, but the actual reality is different, where using a forward and futures in such a way the forward and future price which is capital F exactly mimics the spot in all sense. That means, there is an exact replica of a spot which is there in room 1 and its exact replica is there in room 2 where the forward and futures are being traded. So, now if you can recollect, the forward has the over the counter market and their expiration date is finalized between the two parties, but in the futures it is basically being traded in the exchange. So, whenever you buy and sell, that time duration when you want to buy and sell is less definitely than the expiration date, but is not exactly equal to that. So, and if you can also recollect, we have used the symbol S or the symbol F, whatever it is, with a particular suffix, where the suffix denotes the time. So, with that notion, with that concept, if you see the slides, it says that suppose that F suffix 1 is the initial future price when you go into the market of the futures, that is at time t is equal to capital T1, and F suffix 2 is the final futures price when you basically go out of the market at time t is equal to T2, where time t is equal to capital T2 is greater than T1, and S2 is the final asset price or the price of the asset in room 1 at time t is equal to 2. So, now you basically have two rooms. In room 1 technically you have S1 which is not noted here, and S2 is the final asset price, and in room 2 you have F1 and F2 which is the initial futures price and the final futures price depending on the time. You hedge the futures purchase of an asset by entering into a long futures contract. So, remember it is a long hedge. So, if it is long, obviously you are trying to buy. So, long short would be you will be planning to sell. So, if you are going long for that particular hedge, then your cost of the asset is like this. You open the position at time t is equal to 1, close it at time t is equal to 2. So, your cost of the asset in room 1 is the asset price which is S2 minus would be the difference in the price which is happening in room number 2 at time duration 1 and 2, which is basically the difference in the futures price F1 and F2. So, if you expand this equation, you will have F1 which is the futures price at time t is equal to 1, and the total quantum of basis risk would basically be the differences in the spot and the futures at any particular time. So, if you ask that what is the spot and the futures difference at time t is equal to 3, it will be basically S3 and F3, the difference of that. Now, this is only for one time period, that means for a duration if you consider for 3 months. So, obviously, this is a duration for next 3 months, which is from the end of the 3rd month to the end of the 6th month, or from the beginning of the 4th month to the end of 6 months. Again you will basically have the corresponding basis risk. In that case, it will be not F1, but it will be suffix based on the time period when you are trying to understand. Similarly, for the next time period of another 3 months, which is the beginning of 7 month till the end of 9 month, again you will have a basis risk, where again the time units would change accordingly to where you are trying to consider the date term is and what is the time duration of your total consideration. Now, remember this is a long hedge. So, obviously, the concept of short hedge would be in similar lines, but with the change in the differences of the signs depending on whether you are trying to buy or sell. So, the long hedge for this example you are considering F1 is 32.5 at time t is equal to T1, F2 is equal to 34.6 at the time period is equal to T2, and S2 the spot is 35.0 at time t is equal to 2. Now, you hedge the future position of an asset by entering into a long futures contract. So, the cost for the asset incurred by you is 35 you have paid minus of the difference of the futures or the forward price which is there. So, if you calculate accordingly, you would basically have 32.9 which can be calculated depending on the price differences which you have. So, your actual price is 35 which is given here, and if you consider the basis risk as per the problem, the basis risk would be given by the value of F2 and S2 difference which is 0.4. So, higher the value is or the lower the value is, it basically gives you some concept of what is the overall basis risk depending on the price difference between the spot and the futures at any particular time, which is the total cost incurred by the operator. This total cost means 32.5 plus 0.4 by the operator in order to operate in two markets, where one market is the spot which is room 1, while the other market is the futures. On the other hand, if you have only operated only in room number 1 which is the spot, then your actual cost of trying to buy and sell would have been only 35.0. So, now the prices of buying and selling is now 32.5 plus 0.4. Obviously, we will be tempted to say that yes, we did the good thing in trying to go into the derivative market, but you should understand that if the prices were moving in the opposite direction, you would have made a loss. But your loss in this case, but your main concern is that any price fluctuation in opposite direction to what you think would happen should be considered in such a way that you will definitely go for a futures or a forward as an option in order to mitigate your overall loss. Because if you remember, we are always saying for this course, for the later part of the derivatives, is that your main motivation is to reduce your risk, reduce your volatility, reduce your variance, whatever is the best proxy of the loss. Now, you consider the short hedge, now you are selling. So, hence be very well aware that the word is short. Suppose again the same fundamental principle, F1 and F2 are the initial future price and the final future price, and S2 is the final asset price. So, you hedge on the future sales of an asset that you are going to sell by entering into a short future position. Then again, if you calculate, you will find out the differences of the basis risk is coming due to the fact it is between the difference between the spot and the futures at time t is equal to T2 or 2, and then you basically add or subtract F1. Now, remember why I have used the word of add or subtract F1 is that depending on whether you have bought and sold that particular asset and you are trying to buy and sell in the room 1, based on that you have gone for a contract in room 2. So, only when you are trying to solve the problems for the short and the long, be very careful what are the different type of variables you are using, but also be very careful what are the actual units and the signs. So, if you are selling, obviously input of money would come into your account, hence it is positive. If you are buying, so obviously the amount of money will be going out from your pocket, hence with a negative sign. Again, for the short hedge, you have 32.5 as at time t is equal to 1 is the futures price or the forward price at time 1, F2 is 29.8 at time 2, S2 is 35 at time t is equal to 2. Now, you hedge the futures selling of an asset by entering into a short futures contract. So, that the price realized by you is given by this 35 which is S2 and the difference between F1 and F2. Hence, if you find out the total value, it basically comes out to be F1 and the difference of the spot and the futures at time t is equal to 2, which basically gives you the basis risk. So, once you find out the total price, because you are operating in two different markets, one in room 1 which is the spot, room 2 which is the derivative. On the other hand, if you have only operated only in the spot market which is room 1, then the price realized by you from selling the asset would have been 35 as given by S2 value. Hence, you can understand, again I am repeating, price fluctuation will happen, but what you are more concerned is negative price fluctuation depending on what you think you are going to do. You are going to buy or sell such that you will want to mitigate that overall risk by going into the derivative market. Now, let us extend this concept a little bit more, where again the same thing is there. Futures prices are there at F1 and F2, and the final asset price is there, but there are two concepts, one is S2 and one is S2 star. Now, let us consider very simply this concept. There is one particular product in room 1 and its exact replica of that in the futures or forward market is not there. So, what you will do? You will search in room 1 a type of product which you can buy and sell, which has a price movement which is in tandem with the primary product which you are going to buy and sell. Consider this very simply. Gold you are going to buy and sell at 22 carats, but consider any futures and forwards for 22 carats is not there in room 2. So, what you will do? You will search for a 24 carat gold spot price which is there in room 1 and check that if 24 carat spot has an exact replica in room 2, then you will try to utilize these two things, spot for 22 and the forward and then future for 24. So, obviously, there may be a mismatch in the spot, hence it is being reflected as S2 and S2 star. So, now the cost of the asset would be of two fronts. One would be the spot which is S2, which is you are buying and selling, and another would be the difference in the spot and the futures for both these products in room 1 and room 2. So, technically you are now trying to find out the price difference between the spots and the price difference between the forwards, considering there is a mismatch in the spot and the forward and the future, considering there is no exact replica of that particular spot in the forward and the future room, as mentioned in the example of 22 carats and 24 carats. So, what we are meaning is 22 carat is in room 1, in room 2 there is no such forward. So, if they were, it would have been matched. So, what you do is that you check 24 carat and it has some forward and futures for 24 carat. So, now this movement is there exact, this movement would have been exact if there was something here. So, as it is not there, you will try to basically consider this product, its futures and forward price would come into the picture, plus the spot prices of these two come. Hence, you will consider there are two different spots which are basically being denoted by S2 and S2 star. So, be very careful when you are trying to solve the problem, whether the product which is there in the market, spot and futures are exactly replica of each other. If not, you will try to replace the actual product which you want to buy and sell with its counterpart such that it has a forward and futures. Hence, the price concept based on S2, S2 star or so on and so forth would come into the picture, along with the fact that futures and forwards are also there in room number 2. Consider again a long hedge. So, whenever you consider a problem, we will be considering both the short and the long. Consider a long hedge, the price of F1 is given as 42.8, F2 is given by 43.4. Now, you have basically two spots, a star and without the star. The values of star is given by 42.7, without the star is 44. So, cost of the asset, considering we are in the long position, would now basically be considering the differences in the spots and also considering the futures and the forwards. Hence, the price comes out to be 43.4. On the other hand, if you have operated only in the spot market, so obviously if you are operating in only in the spot market, so 22 carat which you have, 24 carat which you have here, so there is a forward here. So, if you are not operating this or not operating this also, so you are only concerned with the 22 carat whose price is given as 42.7. So, in the first case and the second case, case 1 and case 2, you saw in the second case we only operated on the spot market and only concentrated on the product. In case 1, we considered the product as it is, along with that we consider a derivative for which another product is also there in the spot, but there is some subtle difference between the actual product which you need and the product based on which you are trying to buy and sell the particular derivative. So, you are basically going in this diagonal fashion, but as you are doing that, the effect of the prices of the 24 carat gold would also have an effect in the case of the derived product. Now, when you are trying to do that, you are very much concerned about the ratio or the size of the position being taken in the futures market, whether you want to buy or sell. So, that does not matter. It is basically the size of the futures contract which would basically give you an exposure, hence such that the overall exposure based on which you are trying to do the dealing is minimized. So, remember that when you read the book, try to understand your optimum hedge ratio, the hedge ratio you are trying to find out is done in such a way that your overall risk is minimized, which means that your overall fluctuation in the price is minimized. Now consider this, if delta S and delta F are the standard deviation of the rate of change of their spot and the rate of change of the futures. So, what you are concerned is this and not this. So, you are concerned about this, you are concerned about this, not this. So, the standard deviation which are given sigma suffix S and sigma suffix F are technically this. So, be careful about that. And correlation coefficient rho is that which is existing between these rate of change. Again, rho would have del S, del F. So, I am interested more in the rate of change of the spot and the rate of the change of the futures and what is the correlation coefficient rather than the actual change of spot and the futures. So, what you are considering is the correlation coefficient existing during a time which is equal to the life of the hedge, and it basically is the correlation coefficient between delta S and delta F, where delta S is the change in the spots and delta F is the change in the forwards at F. Then for a short forward, the change in the value of the hedge position is given by this. So, the first quantum is delta S is the spot rate of change. So, this is the total amount which is happening. And the second amount is that if you are basically trying to go for a short futures, then obviously you try basically go for a long and a short position in both these two rooms separately. So, initially what you will consider that if you didn't have any spots, then obviously there is no trading, but the moment you bring the spot for the first time and without going to the futures market, so your only trading would be on the spot market, whether you are buying and selling. Next stage you consider that over and above the spots you have basically the futures and the forwards market also. So, what you are now trying to do is that buy and sell in the spot plus doing a counteractive argument of buying and selling in room number 2, such that the profit function which you are trying to find out is now a cumulative such thing of buy and sell in spot and buy and sell in the forward and the future market, depending on whether you have gone for a long or a short position. So, if you consider this for a short position, the overall life of the hedge, the change in the value is given by this, where H is the hedge ratio, that is the number of such contracts which you want to find, and in the long position which is just the opposite of the short, it is just the reverse. So, what I am buying now would basically be a loss to the other person and vice versa. So, if you try to minimize the overall fluctuation and if you check the book and then try to basically understand that, the overall problem formulation which you have tried to find out is to find out an optimum hedge ratio such that your overall risk is minimized to the maximum possible extent. So, once you find out, the optimum hedge ratio comes out to be a ratio where in the denominator numerator what you see is standard deviation of the rate of change of S divided by the standard deviation of the rate of change of the F multiplied by the correlation coefficient which is existing between del S and del F, where as mentioned del S is the standard deviation of delta S, the change in the spot price during the hedge period, and delta F is the standard deviation of delta F, which is the change in the forward price, that is the change in the futures price or the forward price whatever it is during the hedging period. So, when I am mentioning forward and futures, do not be confused too much about that, because the concept wise they would try to give you the same answer conceptually, even though practically over the counter, not over the counter, being traded at any point of time, being basically traded at the expiration date, these are fundamentally different, but they would not have much of an implication for our course which we are trying to understand in a very rudimentary manner. And finally, as mentioned, rho is the correlation coefficient of correlation, a correlation coefficient existing between the rate of change of del S and del F. Now, consider that you have a hedge using the index features. So, now your commodity is not the practical product which you are trying to buy, it is basically the index in room 1, and you want to basically have such an hedge based on the index such that there is a counterpart of this index which is a derived product in the forward and the futures room. So, now you want to basically hedge the risk of that portfolio, that is the number of contracts that you should buy and sell, that if you find out is given by this ratio. That beta you remember, beta of that particular portfolio which is multiplied by the ratio of the portfolio value. These are also again have to be basically understood in the concept of the rate of change. So, you have basically the P, which is the rate of change of the portfolio value, divided by the value of A, which is the value of the asset underlying the futures contract. So, what you have is basically the change in the portfolio value in room 1 and change in the prices of that particular derivative which is there in room 2. So, now again I am mentioning, so if there is an actual index in room 1, if it has an exact replica, obviously these changes would be based on room 1 and room 2. But as you saw in the example of 22 carat and 24 carat, if you have an actual index which does not have an exact replica in room 2, then what you will do is that you will try to basically mimic the futures and the forward market with another product such that its counterpart is already there in room 1. So, when you find out the rate of the changes, be very careful that the value of P or the value of A which is given have to be noted out in such a way that the rate of change of the prices mimics your actual change of the prices of the spot and the futures to the maximum possible extent, such that you can find out the optimum hedge ratio. Now, let us consider extend it further, that how you want to find out the rollover a hedge or rollover basis risk. So, now consider, if you remember in the last class we have mentioned that for a spot you can buy and sell at any point of time, but not for the futures and the forward, because there is a particular duration. And if your duration in the spot is for 4 months and your duration for a forward and future is 3 months, so obviously there is a mismatch. Number 2 type of mismatch is would be, which may be of a less degree of importance, would be your actual spot and is required for such a duration time which is an even number of times of duration for the futures. So, say for example, your spot is needed in 6 months and a forward and futures is for 3 months, which means that you will basically have 2 such forwards which are being rolled over in order to minimize your overall risk. So, if you consider that in the time frame, what you have, the time frame is given, this is time T1, T2, T3 and so on and so forth. So, in time T1, when you start, you short a futures contract 1, and when time T2 comes, you immediately close that futures contract, but at the same time again shorting a second contract. So, what you are doing is that you start it, close it, but moment you are trying to basically close and start it, you again start with the second contract and continue doing such that you reach the time to maturity. So, as you are trying to do that, there would be basic risk in stage 1, stage 2, stage 3, stage 4 and so on and so forth. So, you should be careful in order to understand that now the basis risk is not for only one period, it is basically based on the rollover basis which is happening from time period 1 to time period 2, from time period 2 to time period 3 and so on and so forth. So, to give a nutshell, the comparison between the forward and futures can be done in this way. So, private contracts between two parties is under forward. So, obviously, it is over the counter, it is not standardized, it is usually one specified delivery date is there, settlement at the end of the contract only, delivery of final cash or the final product does takes place. But for the futures, they are traded in a particular room. So, their futures are traded, they are standardized contract with respect to the non-standard ones here for the forwards. Range of delivery dates are there, they does not depend on the expiry date. They are settlement daily, as you saw in the margin account, in order to take care of the overall risk perception from any of the players, and the contracts usually are closed prior to the maturity, because actually no delivery of the actual product or the commodity does take place between these two players. Suppose that you enter in a short futures contract, sell July silver for 5.20 per ounce in New York Commodity Exchange. The size of the contract is for 5,000 ounces. The initial margin is given as 4,000, the maintenance margin is given by 3,000. What is the change in the futures price that will lead to a margin call? So, obviously, your actual value of 4,000 given, that means this overall value is given, the maintenance margin is given, you know per ounce value, you need this amount of contract. So, you find out what is the difference of the prices happening, whether there is a margin call. If yes, you again pull it back to the initial case, if no, you continue doing your trading. We will consider example 2. Suppose that the standard deviation of quarterly change in the price of the commodity is given, the standard deviation quarterly change in the futures price is also given, the coefficient correlation existing between these two changes, which is rho, is given, then you can find out the optimum hedge ratio depending on the formula which you have already discussed. so we will end this class today, but before I wind up, I will discuss that in the next session. We will cover and discuss the forward price of an investment, forward price for a fixed income, forward price for a dividend paying income, and how stock indices are also calculated. Thank you, and we will see you in the next day of the class.